I'm Jamie Hooper of Remax Crest, and this week we're here to talk to Gord Pipke from Real Mortgage Services about how the recent rise in interest rates may affect the real estate market. Gord?
Thanks, Jamie. This is a very perplexing question and very much sought after answer to this matter of rising interest rates. What is happening is that first of all, let me clarify the two type of rates in terms of mortgage financing. There's your fixed rates, which is tied into the bond market, which is what has been increasing, and then there's the variable rate, which is tied into Bank of Canada Prime. The variable rate mortgage is tied into Bank of Canada Prime, totally unrelated to the fixed rate or the bond market. And this is where there's confusion in the marketplace, because many prospects, many buyers, and many owners think that the increase in fixed rates is affecting their prime rate mortgage. They're unrelated. Then there's also the forecast that the prime rate, which would affect the variable rate, is going up. Well, it hasn't gone up yet. Fixed rates only. Prime rate mortgages may start rising, where, for example, I got CIBC economists and TD economists last week telling me that they're forecasting maybe a half a point, maybe 3/4 of a point over the next year on a prime rate, which would affect the prime rate mortgage. Now, I'd like to, of course, I've got this paranoia that everybody wants to lock in. So how I quite often address this concern is I will then show a client what they'll be paying on a mortgage if they went to lock in versus a variable rate mortgage. And I'd like to show you that right now. For instance, here's a client that's been qualified, including a CMHC insured mortgage, for $313,000 and change. The fixed rate currently discounted, because the posted rate or retail rate is 5.89. So that's available in the marketplace now for a 5-year fixed. So the principal interest on that particular mortgage is $1,435. And I'd like to point out the breakdown as to what that payment does for the client, for your buyer or your consumer or purchaser. $1,110 of it's going to interest, and $325 only is going to principal. So, you know, you can see the distribution, as I call wealth, with respect to what that payment is doing for the owner, property owner or buyer. Now, on a variable rate mortgage, the same mortgage with today's prime rate mortgage discounted, currently available at 1.75. That same mortgage only creates a payment or required payment of $997 based on the same amortization of the previous mortgage example, whereby only $455 of that payment is going to interest and principal is $542. So you can actually see very readily that more than half of the payment is going to principal. So this is why it's a very interesting argument I put forward as to why a client should not necessarily panic and lock in. Because
Can I ask a quick question?
Yes.
So what do you say to people that are concerned as they say, well, gee, if it goes higher than 4.25, then I'm not going to be able to afford my payment?
Well, the variable rate mortgage is open to locking in, but so they may not be able to quote make or afford to qualify for that 4.25 interest rate now. But don't forget, they've had savings over the last 2 or 3 years until the prime rate climbs up to 4.25. As a matter of fact, the prime rate would have to go from today's prime rate at 1.75 to obviously 6.75 before the client would average an interest rate of 4.25, which is today's lock-in rate. So I make
Odds
my
of
case.
that are pretty long.
Well, yeah, the economy would stagger again, all over again.
Gord, thanks for all of your insights. I'm Jamie Hooper with Remax Crest, and to get a hold of myself or Gord Pipke, just feel free to email me back at the address that came out.